Okay, my name's William White. I've been trading since the late 70s. So the stock market grabbed me when T. Boone Pickens and Carl Icahn were coming in, and they were like corporate raiders. So they would come in and grab these companies and bid the value through the roof. So I started chasing them, and I did options in the 70s. The 80s, I kind of settled down, and I went more with mutual funds. So mutual funds used to exist, or they still exist, but they became popular, and they were less risky. So when you got into a mutual fund, you were actually leveraging, there's a different word for that, but you're investing in companies across the spectrum, so you were kind of limiting your risk. I started chasing, let's see, Peter Finch was probably the first and most successful mutual fund manager. So in the 80s and 90s, primarily the 80s, what Peter Finch did is he drove Fidelity Magellan in such a way where he made it the strongest mutual fund in the world. And he owned so much of these companies that when he would change his sector, and you know, and I do a lot with sector funds, when he started changing his but he could move the market in such a way because he had so many shares in each of these companies, like Intel and some of the bigger companies in the 80s and 90s. So my workshop tonight is specifically on ETFs, and it's targeting one particular ETF. Gosh, I need to see the screen. Hang on one second. So I can watch my watch the brief in a live mode. Okay, so either Zoe or Ethan, you got to tell me, is the first slide showing?
Oh, okay. Zoe, you ready?
I'll screen share.
Oh, great. Okay, so specifically, I want to talk about this leveraged technical stock, and it's leveraged in such a way where it's called triple bull. And what these leveraged ETFs do for you is, if a sector is moving, like let's say earnings are coming out and NVIDIA beats and Intel beats and advanced AMD beats, when the techs beat, it drives the sector fund like crazy. If NVIDIA's up, I don't know, 5, 6, 7%, this guy's going to move 15%. So I noticed you just popped the definitions. A little bit more history if I can. So I got interested in leveraged ETFs, and it was directly due to our chairperson, Robert. And John was expressing interest earlier. So Robert runs a war room in the mornings, and if you text him or email him, he can get you into this room and you can watch his trades real time. It's almost like this forum, only a day trading forum. And so Robert does what's called gaps. And what he's looking for, and this is his, got to find the right word for this one. This is his impetus. So if a company misses badly or they beat, in such a fantastic way, in the pre-market, their stocks are going to be up dramatically. The volume behind it, all his confirmation indicators are saying go, go, go in one direction or the other. So his gap strategy had me look for something that was sector specific where I could catch major market moves. So that, and then we another brief history moment. We had the lockdown for 2 years, starting in 2020 through 2021. And it allowed me to day trade. So on my workstation, I had like all these screens going. I had my government laptop, and then I had my personal computer going. I'm watching, watching the stocks on one and watching commentary on the other, like stock twits. Ethan and I are very connected to stock twits because that shows you or gives you an indicator, what are people talking about? And then there's the why they're talking about it. So if it's an earnings beat, like in NVIDIA, that's going to take text and almost move them with it, regardless of what they're postured as. Okay, so definitions. Wow, I need my glasses. No, I don't. I have printed it. Okay, with definitions, the leveraged ETF is, it uses financial derivatives, and it can go either way. You can catch a triple bull or a triple bear. So when the market and the futures are pointing down, let's say, and everything's red, what I'll do is I'll look at the inverse of this, the 3x bear, because, and I love techs, because techs are the hot market right now, especially with the AI infused into it. So someone had mentioned biotechs. I love biotechs. I love the gold ETFs, and I love the oil ETF. I'm trading that probably once a week. When it gets below 60, I get in long term with like a triple bull on oil, because it's going to go back to 70 and 80. And when it does, this triple bull just screams for like 3 months. Okay, so that's the first definition. The second one I'm introducing in this brief, what's called an inverted hammered candlestick. And what this guy does, especially on a down surge, when he pops, what's happening during the course of that day is the buyers and the sellers are trying to go, they're each trying to go in the direction they want this stock to perform. But invariably, it hits a high that it doesn't close at. It comes back down, and maybe in the last hour or two, or the power hour, which they call between 3 and 4, it'll come back down and it'll close at a certain point. But the strong momentum trade behind the inverted hammer candlestick is you're getting a lot of action. You're getting a lot of buyers. You're getting a whole lot of sellers. And people are collaborating, and they're playing it. And the breadth of that candle is usually significant. It's one of the bigger candles. Doesn't have to be, but oftentimes it is. And it indicates in the near future where that stock's going to go. So as a short-term play, which is what I'm trying to brief in this workshop, it's a strong indicator of trend reversal. So on a down surge, it'll stop at a certain point with this particular candle, And then the next 2 days, if you're looking for confirmation, if they're both up, that's the all-in move. That tells you that, yes, this thing has stopped, it's found its bottom, and now it's going to trend upwards again. And then I've talked a lot about V-bottoms. When I show you the chart of SOXL, you'll see just how much potential a reversal has. Okay, next slide, please. And again, I owe the ETFs primarily to Robert. So I'm chasing sectors, but I'm looking for the big bang. Either give me a triple bull or a triple bear on a sector. And that's my day or my swing trade. Okay, the Williams percentage R. I look for metrics that act as confirmations on whether this stock is truly oversold or overbought. And if so, what direction will it move in the near term? And near term can be in the next 3 weeks or in the next 3 months. But I have never stayed in an ETF for 3 months. So my Williams percentage R is significant because he's going to caution me or tell me when the ETF is likely either at its high and therefore due for a correction, or is it at its low and we're looking at a trend reversal. It's been around since the 80s, and I started using it primarily for swing 3 to 6 month trades or long term on a mutual fund. Okay, volume spikes. So I'm a momentum trader. My entry points are all geared with confirmations that tell me what a stock is about to do or what an index is about to do. So these triple tech guys, SOXL and SOXS, will move significantly when the market's changing its direction. Like in September, and I don't want to be in the market prior to the Fed meeting, but their decision, not only on how much they're going to ease, but by how many basis points, is going to be so significant in where the market's going to go in the next 30 to 60 days or through the end of the year. The Christmas rally can start if they ease, like, say, 0.5 percentage point and everybody's expecting a quarter. My goodness, the market's going to start screaming upwards. But even better, these ETFs are going to scream at a rate of 3 times. The volume spike is significant with either a day trade or a swing trade because that tells you how much action's in play. So if you're at a bottom and you get strong buys coming in, and its volume is more than anything you've seen during the day, it's more than anything probably the previous week, that tells you this is what we want, this is where it's going. It drives the stock. It's a strong indicator for a momentum trade. And finally, trailing stop losses. These ETFs are so volatile that, and like Sanjay was talking about him, and the caution he has, they're so volatile that I would not recommend anybody risking more than, say, 4 to a 5-digit investment. You don't want to be moving your big boys into these things and then wake up one morning and you're down 12%. You don't want that to happen. That is a very uncomfortable feeling. And, I've taught workshops on what 12% really means, or like Chris was saying, he's lost money. A lot of people lost 40% on that last major correction. And I think it was due to banks, if I'm not mistaken, bank failures and all these gimmick loans they had out. But the market and a lot of people I knew lost 40%. It takes time, a year or two, for it to ever get back to the point where it dropped. And to make up 40%, you have to make 80% to get back to your break-even point. It's not the 40% that you just lost. You have so much that you have to make up for, and it's so much time. I will never allow myself to take a 10, 20, or 30, or 40% hit. The most I will risk losing is 5%. I'm not, especially with these ETFs, I'm not going down 20%, chasing double your money. Okay, next slide, please. If I turn on the light, what happens to me? Can everybody still see me?
Yes, we see the screen.
And there's a sound check, so I know people are hearing me.
And is this
Okay,
we can hear you. Is this the correct slide as well? Just want to make sure.
Yes.
Okay.
I should have numbered them like page 1, page 2, because that makes it easier to get them into order. So Nathan called me, gosh, maybe Monday, and asked me if I could put something together. And it was easy to do because I love these leveraged ETFs. And in my watch list, that's what I'm looking for. That's what I'm following. I used to do penny stocks, like our Connecticut Queen was talking about, because you get a real good ride on them or not. But as far as day trades, these guys are phenomenal. Okay, so the entry point, and I forgot my numbers that I had written down, was August 5th. And there's a couple confirmations that I look for, especially in a swing trade or even a day trade the next day. What's the action on that candle that can help depict where the stock and where the market's moving off of certain action? Because the action of the market and the volume, we have a professional trader that does only gas futures, and he'll tell you that he won't chase anything whose volume's not either 200,000 or 500,000. So the volume on this puppy hit 2 million on that day that signaled a form reversal. So if I had programmed AI or an expert system to decide in my absence when to trade, it would have had several confirmations associated with it. And one of them, one very strong one, is the volume. And then the second confirmation is the Williams percentage R. And it had been sitting at the oversold point for maybe a week or two, just ready to start moving. And the beauty behind Williams percentage R, unlike a lot of popular metrics, is it's real time. It's, especially with the day trade, it's not a laggard. When you're watching Williams percentage R, you're watching exactly what's happening to that index. So if you got it at its low point on August 5th, I think it was $22.85, which is like really low for this guy. And you rode it, and you rode it up to, let's see my numbers.
Hey, Bill, real
I think
quick,
it's in the,
just for everyone's
yeah,
edification. So we're talking about, just because we have some beginners in here too. You're talking about the green at the bottom of the screen, right?
green.
The green line.
So I've lost my color significance. So the entry point on August 5th, if you're on a computer and you pulled this up, it's a green candle. It's not a red candle. So the significance of that is that between the open and the close, more buyers came in, and the breadth of that candle is so far more significant than most of the other candles around it. And the next 2 days, actually the second day off of it, which is kind of what scared me a little bit. And I was kind of a laggard coming into this. There was a huge sell candle coming in. And had I been in, and had I had a triple stop loss, I would have got stopped out. Because that puppy went down 10%. It was a major move, and it was wanting, and it was telling me that I want to go up, but there's so much selling pressure, I'm going to go back down, and here's why. The market in general is overbought. Every day the Dow closes or the S&P closes, they're closing at record highs. So there's a pressure out there to correct that and begin to move back down. It's hard to move higher once you've hit record highs. It's just really hard. But the momentum behind this, the stock market in general wants to go higher. Companies, when they report, are just blowing away expectations, earnings, and estimates. And the market, because of the global nature of these companies, is moving higher and will continue to move higher. How high? For the next 10 or 20 years, it's exponentially high because of what's going on. So getting back to this chart, if you got in on day 4, when it was beginning to consolidate off of that strong down surge, there was an impetus to go high, to come off of, say, 25 and move higher. A lot of our professional traders, and I am not a professional trader, I am a semi-professional trader, but a lot of them will tell you, when looking at a chart, what gaps need to be filled. Now, SOXL, when you look at this chart, it's starting to form a V pattern. And that V says it wants to go up to the point where it's come down from, which is its high. And so techs have their own impetus going. There's catalysts behind each and every company to want to go higher. This thing wants and will go back to the point where it hit its high. So you have all that movement there in the next 6 to 9 months. And Sanjay will probably chime in as to what significance that movement is. And here, it's fundamental. Can you get another, in the last, 15 trading days, or maybe 8 trading days, you could have gotten close to a 60% return on investment. But to go even higher, can you get another 50 or 60% by December? And the answer is absolutely. Absolutely. Next slide, please.
Wait, can I ask a question on this slide?
Oh, you can ask loads of questions. I love your questions.
Okay, so I'm just trying to make myself make believe I'm you and I'm in the situation, and you're in the situation daily. So you're looking at the chart, but you're in the situation in real time. So back on August 5th, you have that on my screen, I have white and blue candles. So you have that
Uh,
big white candle on
right,
August 5th. Now,
right,
at
right, right.
which point do you feel comfortable to enter on that day, or do you wait a couple days that you feel it's going to continue to go up and not go down?
Well, I may have taken that as a day trade that day
Uh,
because I'm looking at the chart saying I need an entry point in the XOSL. Not just for day trade, I need a swing trade. I need something that's going to get me to the Christmas run. And oftentimes it starts in September, where the momentum between September and December are phenomenal in a good market. So if the Fed eases half a percentage point, which I believe they will, this thing's going to scream. So I may have taken that day trade, but there's another side of me that says, oh, I absolutely want the swing trade that's part of this. And you mentioned a couple NVIDIA ETFs, and I'll talk about them close to the end of this presentation. Did that answer your question, Ethan?
yes, yeah, terrific, terrific. I'm sitting here, I know, but everyone else wishing I had seen it at $22. Wow, what a steal! That's 16 points.
Well, yes, Sanjay and I are looking for our entry points. We're looking at these ETFs, and if they're at their high and the market's going down, then we're looking at triple bears. This thing was just the opposite. This thing had an entry point, and you knew it eventually was going to have the entry point into it at its bottom. And all that action, that candle, the breadth of that candle, the fact that 2 million shares traded off this thing was like beyond. Okay, so on this slide, the beauty behind this triple guy is one of its heaviest holdings is NVIDIA. So when NVIDIA, NVIDIA is going to beat, like it's beat the last, I don't know, 6 times it's reported. But the move is to get into this thing the week before NVIDIA and all the techs report, because they're all kind of lumped together. Microsoft reports, AMD is the first, so it's already reported. But I love this thing because I don't want to go all in to NVIDIA, but then I have another system behind this where I do play certain stocks for certain reasons. NVIDIA right before it split, Apple right before it split, these heavy hitters, when they split, they're splitting because they're trying to make their stocks more attractive to the average investor. So NVIDIA at 1,000 a share was almost untouchable for the general population. When they split 10 for 1 and went down to 100, now all of a sudden more people can buy it and more people can begin moving that stock in the right direction. They split because all their fundamentals are solid, and it's exceeded their expectation as a corporation as to where they want to be and where they are now and where they want to be 6 months, year out, 5 years from now. And one of my systems is when a stock splits, if you get in right before the split day, if you had bought NVIDIA at $1,000 a pop, the day before it announced and made that split, you would now have 10 shares at $100. The theory is those stocks will get back to the point where they split within 5 years. And it's generally within 3 years. So NVIDIA, you're going to get back to 10,000 or 1,000. But you now have 10 shares that you bought at 100. So now you're sitting on, you know, all these shares that are worth the same amount of money that that thing was worth right before it split. It's a phenomenal investment. So I just wanted to show you the holdings behind these things. And they're significant, you know, 6% of something that's valued into the billions is a significant holding that it has into that particular corporation. Okay, next slide, please. Okay, so this is the bonus slide. This is kind of a little later than a mid-year checkup on my sector rotation. So back in late January, it may have even been the first week in February, because we had so many speakers, I spoke on sector rotation. And my theory was that the big market managers, money managers, fund managers were moving into the techs. It was the hottest sector last year. And now you have AI behind it, driving it even higher. Oh boy, it's going to be not only the hottest sector, it's going to be on steroids, because all these companies are posturing to profit off of AI. Microsoft and Google, Amazon, they're all doing things in the AI market that's just infusing the text like there's no tomorrow. So I put FSELX on here, and it's a Fidelity sector fund that's totally specific. I probably should have put its holdings on here as well. It's totally geared for technology. I like, if I'm going to risk $500,000 or $1 million, and I'm going to put my significant 6-digit guy, 7-digit guy into these things, I want something that's relatively stable. I want to be in techs, but I do not want to be in those triple leverage because of the volatility. So the Fidelity Select funds are still like the cream of the cream. And it used to be that you could only get in with a minimum of investment. I think it was 25,000. But now they've opened it up, excuse me, where if you just have a Fidelity account, no matter what your balance, they'll waive the requirement for buying these things, buying them and selling them. Fidelity doesn't charge you transaction fees anymore. And for the day traders, that is significant, because that transaction fee based on the amount of money you were trading, you know, what's going to eat a day trade's move. So you almost had to move. Ethan, you talked about targets. You almost had to move twice what you really wanted it to move just to cover the transaction fee. That thing's gone. So I put this on here to show, and if you superimpose the two graphs on top of each other, they're moving together. This guy ain't moving with the same volatility, but when you have so much money into it, who cares? If I get the 10 to 20 or the 30%, that's all I'm looking for say 6 months or whatever. Generally, these selects will give you 60 to 70% off of your entry point. So if you got into this thing on January 31st, you would have made up to now, you would have made 20 to 30%. So I'm kind of closing out, and I'm going to open it up for Q&A here. I want to call on Sanjay if he's still here.
Yes, I'm here, Bill. Can you hear me?
Yes, talk a little bit about your entry point into FSELX, because
That was-
you watched my sector funds
Yes.
strategy
Mhm.
for a few years before
Yeah.
you ever moved it. Which was the right thing to do? You know,
Yeah,
it's one thing to have a strategy, and what Robert and Ethan and Carl and some of the heavy hitter professional investors will tell you, don't play with real money until your system tells you and shows you that it's strong over a period of time. So I'm going to open it up real fast to you, Ethan. Thank you.
I played this one very well in 2024. Actually, thanks to Bill, he presented in 2022, 2023. I was like not sure because I never bought mutual funds. I'm more like a stock kind of guy, little bit day trading on the ETF. Still, I play TQQQ. So this one is a very interesting journey that February we had a meeting, and then I put on my IRA like a bigger amount, first time this year. Even he spoke about this mutual fund last year and previous year, but it took me a little time to digest. So this year I put a big, like a six-figure amount on this. And he also mentioned to me that you have to put a trailing stop loss in mind, because in mutual fund you can do that. But I watched, because when you put a big amount, you keep looking every week, weekend sometimes. And a lot of charting system, they don't show you as FSELX, but luckily Yahoo does. Yahoo does a very good job with ATR, trailing stop loss. So luckily, like before the market correction happened, it kind of automatically tells me, because it was gone like 38% up, and then bam, it came down to like 10% like in a jiffy. So I sold it. Unfortunately, the mutual fund NAV that gives you the next day price for some reason. So my I got little loss on that part. But again, when that inverse hammer candle happened, I am back in the same mutual fund out of like that money that I made. So I'm not worried now. Even if it goes down, I won't be never like be in the negative red number. And again, I'm expecting 20-30% jump due to this Fed price cut. That's my hope. But either way, I'm happy camper. Thank you, Bill. I would like to add one thing for Ethan, because you said you are a swing trader. So there is another ETF I found, which I'm also doing on my regular trading account. Is called USD, United States dollar, but it's basically same SOXL, but it's a 2x, not a 3x ETF. So the risk is less. And you know, the funny thing, in 7-8 trading days, it's like 20% up. I can't even believe that. Means it just, SOXL is way up. But suppose you want to do a swing trade and you are afraid of losing the money due to volatility, you can try USD. I'm writing that in the chart message. This was something I just tried because somehow I'm like little chicken, as I said before. When I make big money on SOXL, I can't sleep in the night. Thanks to Bill. Now I'm doing this one, which I just messaged in the chart, called USD, which is easy to remember. So that one is 2x instead of 3x, where the downsize is much higher in a day-to-day basis. This one holds pretty good, actually. It never goes more than 10% down in any day. I back-tested for last 10 years. It was never gone like less than 10%. And if you guys are still worried about the money, then another one I have been doing experiment from last year, which is not a 2x, it's just a 1x, like all same thing that you get in a mutual fund that Bill is showing in the screen. It is same in a ETF, which is S for Sam, M for Mary, H for Henry. So please look in these two. If you have little bit risk appetite, go for USD. If you are totally like an investor, wants to hold it for months and months, then please look on SMH and their top holdings. Over.
So real fast before we open it up to more Q&A, there's a site called etfdb.com. What they do is they track different sectors and they track the different leveraged ETFs. So you were talking earlier about a couple of the ETFs that are on NVIDIA. The biggest year-to-date earner so far is NVDX, as in X-ray. It's made over 400% this year, and it's the 2x long on NVIDIA. Just extremely powerful. So if you're looking to go NVIDIA and ride it from, you know, the mid hundreds or 200s and ride it back up to 1,000, this thing is going to get you a lot of money. Okay, back, open it up to Q&A.
Does anybody have any questions for Bill or comments or anything related?
Yeah, I have a question, Bill. When you're trading the SOXL, is this a day trade only, or are you swing trade? Because if you bought it on, because I also bought it on August 5th as well. I didn't buy it in the morning, but I bought it later on in the day. And my cue to buy on August 5th was when the VIX shot up to 65. So I kind of figured that was a flush down day. So I bought that. I'm still holding it, but so I don't mind holding these 3X. So I'll hold this for the rest of the year, or maybe even through next year. Do you just day trade these and then you buy the Fidelity Select for your, and I don't have a 6-figure position. I mean, you do have to manage your risk. I have a decent 5-figure position in my SOXL. And did you day trade them, or do you swing trade them, or do you hold them longer? That was my question.
Bill, you there?
I clicked the wrong button. I clicked the video button. So to answer your question, John, I'm doing both. So with the day trade, which is mainly my Roth accounts and some of my lower brokerage accounts, 4 or 5, you know, a real small 6-digit, I will come in and day trade SOXL based on, you know, the activity of that day. Market's down, it's been down, it's consolidating. You kind of know it's hit its bottom and everything wants to go up. Like you, I was looking for the entry point into SOXL, and but I'm also looking for confirmation. I'm not aggressive enough to go $500,000 or $750,000 into this thing thinking that I found the bottom. I want it to be the bottom, and I'm looking for confirms. The volume spike and Williams both told me, yes, we're at a bottom. Now, what's going to happen the next 2 days? And what is the market driver and the impetus and the action behind these things that's going to move it forward? You know, there's whisperers out there, yes, the Fed is going to ease. And the fact that the market is going to scream right up until September will tell me, you know, what a great play this was. And we can, you know, John can maybe do a presentation of his entry point and then his exit strategy, because it's so important that you have prices where you'll sell. If you've doubled, tripled, quadrupled your money on some of these things, take half off the table. If you take half off the table, then your exposure is minimized in such a way where you're not going to lose as bad as you would have had you stayed into this thing. But is SOXL a good 3 month, 6 month, 1 year trade? Oh, heck yes. Is it as good as that NVIDIA thing that I was telling you, the NVDX trade? No. If you want to posture into one of the major stocks behind the AI movement, it's NVIDIA. And to get a leveraged ETF on that guy, I would hold more in that position longer than I would SOXL.
Okay. I mean, I'm more comfortable doing the SOXL because it's a diversified ETF, because SOXL has Broadcom, NVIDIA, Qualcomm.
Oh, it's got them all. Intel.
Yeah, so it's more diversified. Whereas if you're doing a single stock leverage, you're betting the farm on one stock, and that's true. That's just a little too much risk for me. I don't mind holding the 3X because I know that these things are diversified, but it's just a single one. And I mean, obviously it's NVIDIA, so that's a good play, but it's kind of hindsight. Yeah, if you bought that in January, you're up 400%. But it's always easier kind of looking back at it. But yeah, I have a diversified holding of SOXL. I have Triple Q. I have SPXL, and I have the healthcare one. So I have kind of a diversified portfolio of the 3X ETFs. And I think the Fed is gonna cut rates 25. It's almost 100% baked in, 100%. In September, they're going to cut another 25 again in November, probably another 25 in December. You got like payroll report coming out the first Friday in September, and you got NVIDIA earnings coming out on the 28th. And then I think the following week you have Broadcom. So those are all little impetus for this semiconductor ETFs to be moving. So yeah, just appreciate that answer. Yeah, so you're holding it long term. You can hold it long term, and you may do it short term, but yeah, I'm holding it long term. So I just want to. I'm kind of in the ballpark with you and others, so that's good.
You said your entry was August 5th, right?
Yeah, that's the day. That's the day. I think that's the Monday, if I'm not mistaken, when the Japanese yen or the Nikkei blew up, and that's where they had. If you look at the volatility, because I trade using interest rate volatility, I use a lot of fundamental economic data points to decide instead of just pure technical analysis. If you look at the VIX, that spiked to 65. That's like financial market crash meltdown numbers, and so you kind of knew that was the bottom. I mean, the stock market, the S&P the market took a few more days to bottom out before it started running higher, but I think that was pretty close to the bottom, and that's kind of an indicator. I just wanted to make sure it wasn't going to go any higher than that. That's why I waited towards the end of the day. So my entry on the SOXL was closer to 27 rather than 22.
I see. I was looking at the chart for the whole year, and it looks like you still have a very good entry position. So.
Oh yeah, especially if it's going to fill that gap and go back up to the point where the V started. On August 5th, if I remember, it was up 16%. And I got in with my day trade, probably at 5. And I do, and Carl hates me for this, I sell into a rally on a day trade. Because if I'm getting, my goal is to get 2%. If I get anything higher, I start liquidating my position. So by the time I've doubled my money, I only have like a 30% exposure going. I've made my numbers already. There's nothing more that I want out of that day trade. And I'm surely, with the kind of money that I invest, I don't want to take SOXL overnight. That's where, and Sanjay talked about this, you go into the more stable technical mutual funds that aren't going to lose 15, because when the market turns and this thing starts going down, it'll lose 50% in a course of a week. I'm not writing that thing down. I want to come back in. I want to sell, come back in at a new bottom and write it even higher.
We want to thank Bill very much for an outstanding presentation. That was really great.